All right, guys. So, welcome to the fourth and final part of our series on financial literacy, stocks, bonds, and mutual funds. Here we go. So, here's my disclaimer. Investing is extremely complicated and full of risk. I'm not a professional, and all information provided here is for informational purposes. I'm not responsible for your investment choices, and I recommend that you talk to a professional before you invest any money. I am a science teacher. I did not go to school for finance. I don't know all the ins and outs of finance, but these are some of the basic information I can give to you guys about these different types of investments so that maybe if you decide to get in there, it's a good way to give you a baseline information before you actually go and get more information. Okay. What is investing? Well, people invest money in different ways. Basically, what they do is they turn money that they have into more money in the future. So the idea is to make more money. Some extremely rich people just get all their money from investing. So if you have tons and tons of money, you can just put your money in the stock market or what have you, and you just make money off of it. Okay. But just because you don't have money, a lot of it doesn't mean you shouldn't invest. In fact, if you start now, you can make a lot of money. So starting investing early can make you a lot of money. Why should you invest? Well, investing is planning for the future. Eventually, you're going to be too old to work and you will need money to live. The government only provides a little money when you retire, so it's a good idea to get some money for yourself. So they give you Social Security, and Social Security gives you a certain amount of money based on how much money you paid into it, but it's not a lot. It's not enough to have it's poverty wages, basically what it is. Investing allows the money you save to grow on its own and get bigger. So it allows you to save some money and allows you to make that savings money get bigger. Using a savings account is fine, but you may only make a few $1,000s over the course of 30 years. So that's not a lot of money over 30 years. You should be making a lot more than that. Investing can grow your money a lot faster. You can make a lot of money over the course of 30 years if you use investing. Okay. But there's also a risk that you could lose that money too. Okay. So the whole point of investing is how much do you want to risk? Because investment is calculated risk. When you decide to invest money, you could make a lot of money or you could lose it all. Most people try to manage the amount of risk they have when investing, and some say screw it and go for it. I'm going to let you know the risk level for each investment I talk about here. Okay. So usually, if you have a higher risk investment, that means that there's a chance to make more money. Like you can make a lot more money with high risk. But usually if it's a low risk investment, there's lower returns. Okay. Return or return on investment is another word for the money you make investing. So the more risk you take, the more chance you make a lot of money. But also the less risk you take, the less money you make. So that's just kind of one of those trade-offs. So stocks are probably the one everyone knows about. Okay, this is the one we saw in the news with GameStop stock. That was what was being bought and sold. It caused the price of this GameStop stock to go up. Okay, basically a stock is pretty high risk. Okay, if you think a business is going to grow and make profits, buy their stock. If they do end up making profits, then you can make a lot of money. This type of investment has the most volatility and risk. Volatility means like ups and downs. Okay. So a stock could go up and down a lot over the course of time. And so one day you could be gaining tons and tons of money. Another day you could have lost it all. So it's very, very risky. Okay. Many people have become millionaires due to the stock market. You can go and invest a couple $1,000s into the stock market and make millions. It's not it's happened before. But people have also lost everything due to the stock market. I had a man who I worked for. He was a manager of mine, and he was trading stocks, thousands of dollars in stocks, day trading, what it's called. And it's very, very risky. You can make a lot of money easily that way. He was day trading, and the market crashed, and he lost all of his retirement money. He was set to live for the rest of his retirement, didn't have to work anymore, but because of stocks and playing around with stocks, he lost all of his money and had to go back to work. So you really have to be careful. Stocks, you can lose all of your money with stocks. Okay. You have to be really careful. Basically it works. It works where each publicly traded company has a set amount of shares that are out on the marketplace. If you own a share, you own a part of the company. So if you own one share of the company, there's maybe millions and millions of shares. But if you own a share, you own a part of the company. You have to buy it from somewhere else, though, who sells it to you because based on the current value. Because the idea here is that there's a certain amount of shares out there, and those shares are out there. Some people own them, and you want to buy them. You got to buy them from somewhere else. Okay. Now, if you buy a stock and then it goes up in value, you can sell it for a profit. So that little certificate that you have that says you own a part of the company, if the company becomes more valuable, you can sell your share for a profit. If you own 51% of the shares of a company, then you're called the majority shareholder, and you are basically the owner of the company because you can make all the choices you need about that company because you're the majority shareholder. Now, next is bonds. Okay. Bonds are like investing in governments. Okay. They're low risk. Bonds are created by governments in order to raise money quickly when they need it. If you buy a bond, the government is promising to pay you back with interest in a set amount of time, usually 5, 10, or 30 years. Okay. So a bond is like if they want to build a road and they don't have money, they'll say, okay, we're gonna create some bonds, and basically banks or individuals will buy the bonds, and it gives them money so that they can go build that road. But they have to, in 5, 10, or 30 years, they have to pay that money back with interest. You can buy and sell bonds like stocks, but they will eventually mature like after 5 years, and you'll get all the money back from the government plus interest. So usually you can buy and sell them, but usually you hold on to a bond and wait for it to mature. And then when it matures, you get all that money plus interest. These are low risk investments because governments like the US almost never default or miss payments on their bonds. So the US government always pays their interest. So if you buy a US Treasury bond, people buy bonds, for example, US Treasury bonds, when they want a safe place to put their money. They're going to get like, I don't know, a 1.5% or 3% on their money every time, no matter what. In fact, the government pays billions and billions of dollars in interest every year to people who have Treasury bonds. 15 to 20% of all the entire US government budget is just paying interest. Huge amount of it. Now we're getting into the weeds a little bit. Mutual funds. This is called managed investment. This is like a medium risk. If you want someone to invest for you, you can invest in a mutual fund. These are groups of stocks and bonds managed by professionals. These professionals charge a fee each year for their services, but having a professional do the work trading stocks and bonds can lower your risk. So basically this idea is that mutual funds are taking a group of money, a group of investors, and having a professional take care of the investing for them. Okay. So there's a little bit less risk. So you don't have to worry about the businesses that you're investing in. You don't have to worry about the bonds. You just give them your money. They charge a fee, and you can invest without having to worry too much. And what's cool is you can invest in basically anything you want to. They're kind of like themed, kind of like choosing an ice cream. There's a ton of different options. So you can invest in just oil companies, or you can invest in just video game companies or just fashion companies. There's hundreds, if not thousands of different types of mutual funds you can invest in based upon what you want to invest in. There's a green energy stocks are a big one right now. So you can kind of choose a mutual fund to fit your category that you like. Okay, retirement accounts. There are many types, but we're going to talk about 401ks and IRAs. Okay, so these are a little bit different than stocks, bonds, and mutual funds. These are like specific things. Okay, for a majority of people, investing is a way to save for retirement. Many lower the amount of taxes you pay. So basically, retirement accounts are a way to invest while lowering the amount of taxes you pay on that money. Okay, the earlier you start using these products, the more money you will make. So start early and invest as much as you can. So retirement accounts are something that you start if you want to save money over the long term and you want to invest. Okay, and so let me tell you about what they are. We're going to talk about IRAs and 401ks. So an IRA, or an individual retirement account, okay, there are many different types of them. Okay, we're not going to go into those types. Okay, but these types of accounts allow you to invest money in mutual funds and limit the amount of taxes you pay. So it's pretty much the same thing. It's kind of like an account where you will you buy mutual fund stocks, you buy money, put money in mutual funds, but there's usually a limit on when you can take out the money. So, for example, you need to be 60 years old to take out the money to save it on taxes for an IRA. So usually with mutual funds, you can put money in and out whenever you want to. But if you put money in an IRA, you put the money in and you need to leave it there for a long time. And if you leave it there for till you're 60 years old, or at least 5 years, and 60 years old, you'll save money on taxes. So it's just a way to save money on taxes. Another way of doing this is 401ks. And this is the most common investment product offered by employers. They're pretty standard, and they took the place of pensions. Pensions were like guaranteed money after you retire, but companies don't do that anymore. They don't just give you free money when you retire anymore. So basically, this is like an IRA. A 401k is an IRA where a company will match you. If you put 3% of your income in every month, they will give 3% as well. Okay. So they're basically doubling your investment. Okay. And so that limit is usually about 3%. And you can't really take the money out tax-free until you reach a certain age. So they're very similar to IRAs, but 401ks are better than IRAs in a lot of situations because the employer will actually give you free money as well. It's kind of like a benefit. Okay. So here, if you want to take a look, I posted this slideshow on the Google Classroom. If you want to look at this, or your educator could look at this, or you can pause the video and take a look at some of the differences between some things you should do with a 401k. So here's the main difference, remember? Okay, so an IRA is where you set up an investment account and you can make money and you don't have to pay as much taxes and you can make extra money. 401k is that both your employer and you both put money in the account and then you still make money. Okay, so they're basically really similar things. And you can get a whole bunch of different types of these IRAs and 401ks, but this is just kind of one general way to use. This is mainly mutual funds, stocks, bonds, mutual funds, depending on what you want. But this is one way of making extra money. Okay, so do you now have more questions than before? This is normal. As I said, David Pumpkins, any questions? Investing is really complicated and people spend their whole lives figuring this out. So this is advanced stuff and it should not be your priority if you don't have a job yet or if you don't have any money yet. Focus on getting money and then building your credit. If you start by getting money and building your credit, you're going to be able to build some wealth through making a loan and buying something, get some wealth in. But once you start feeling comfortable, you have a little extra money in your pocket. Maybe you got a raise or you got a new job. Think about investing. Come back here, maybe look at this information, and then talk to a professional about getting some more information about investing. Okay.